Well, happy 2024. Happy New Year to you all. I hope you had a restful holiday. I trust Santa found you and treated you well. It's January 2024, so that's time for our year-end review and our fourth quarter recap. So let's have a quick look at the numbers here. I'm going to share my screen with you. 2024 was a fantastic year in the markets, or 2023, sorry. I'm jumping ahead on you. So when we look down here on 2022, you can see there was an awful lot of red. 2023 is remarkably different. Canadian market posted a return of a little over 8%. The Dow Jones was up about 13. Remember, that's just a basket of 30 stocks. The NASDAQ was up 43 after a tough year in 2022. The S&P 500 had a fantastic year. We're going to look a little bit deeper at that one. But the rest of the world did reasonably well as European market was up all the way through here. Japan was the big leader, up 28%. Gold was up about 7%. Oil was off a little bit. So what's kind of interesting here is in 2022, we had more than a 10% drop, followed by a 10% gain. Historically, that means that 2024 is likely to be a green year if you use history as a guide. But when we go back and we look at the S&P 500, I said we'd come back to this. It was really an astonishing year for a handful of stocks. If you look here, here's the ticker symbols for those stocks. That's Meta, which is Facebook, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA. As we were approaching the end of the year, that basket of 7 stocks was up 71% year to date, having a gain for the market of 19%. We know it finished a little bit higher, closer to 14. So this is before year end. But that is the effect that that basket of 7 stocks had on the S&P 500. If you were to remove those 7 names and just look at the remaining 493 companies, the U.S. market would have only posted a gain of 6%, which is rather astonishing when the market had a gain of 4 times that. As we're looking back in the quarter, November saw the biggest buyback in corporate history. As you can see down here, more companies bought back stock during the month of November than any other time since 2008. So that shows that balance sheets are strong for corporations. Also, right near the end of the year, the S&P 500 ETF that replicates the index had its largest inflows in a single day of almost $21 billion was put into that ETF right near the end of the year. An encouraging sign that money's getting put to work. What's also interesting is how the year ended. We know that August, September, and October were 3 negative months in a row. Those 3 months have only been negative 5 times in history, so it's a relatively rare occurrence. But when the market turned for the final 2 months of the year, it really broadened out the breadth of the market. And this is a chart on the Russell 2000, a basket of 2,000 stocks in the US. And you can see the gain that happened in the last 2 months of the year, just in 48 days, the recovery that space, those 2,000 stocks had. We saw that across the entire global market landscape. And that's really on the declining interest rates as we move forward and what's anticipated to come in terms of strength in the market. And it was nice to see this broadening effect because those 7 stocks that make up the bulk of the gain for the S&P 500 index had been a little concerning that market leadership was relatively narrow. And to put it in perspective, the size of those companies, Microsoft and Apple are the 2 largest companies in the world. Changes kind of day to day, but roughly Microsoft's worth about 2.8 trillion. Apple's worth about 2.9 trillion. There's been a couple of times where Microsoft has been the larger, Apple has been larger more often than not, but those valuations are pretty close. But if you go back and you look at the US market in 1990, the entire valuation in 1990 of the US stock market was $2.8 trillion. Now, each one of those companies have a valuation greater than $2.8 trillion. This rally that we just had is largely, this is a chart looking at the yield on the US 10-year Treasury bond. And so you kind of see it peaked there at 5%, and kind of as the year was winding out was actually sub 4%. So interest rates are coming down. These are the market expectations for the US Fed funds rate. As you can see, as we move through calendar year 2024, this is where they anticipate rates will go. I'm of the opinion that maybe this is a little bit aggressive. This is what the market's pricing in interest rates to be as we move forward. I think that the gains at the end of the year in November and December pulled maybe potentially some of the return from 2024 into 2023. And so we went from October 27th was kind of the market low. We were in a, significantly oversold position. And, I was expecting a rally in the market. The rally was much stronger than I had anticipated. However, that real strong rally in a relatively short period of time has now put us in, what I'd argue is an overbought position. And so now I expect, maybe a small or modest pullback in the market, or at the very least to maybe go sideways for a period of time to digest some of those gains. So here's a comparison chart, because we're now I think we're all of the mindset that the interest rate increases are behind us. And so this is a year over year kind of comparison of a couple of time periods. 1982 versus 2023, it was very similar. Back in 1982, the S&P 500 troughed at August 12th, and Volcker declared victory against inflation 37 days later. And during that period of time, the market rallied 19% and continued strength into the following year, 1983. That chart looks eerily similar to 2023, where the market troughed, as I said earlier, October 27th, and Powell has declared victory December 13th, 33 days later, and the market had a 14% gain over that 33-day period. And we continue to see strength going forward in the market. Also, we're in the fourth year of the US presidential election cycle. Historically, 83% of election years are positive years, the exception being 1940, 2000, and 2008. So we would certainly expect that we'll see some strength in the market this year if we use history as a guide. The other thing that stands out to me, and it really goes back to some of my earlier charts talking about that handful of 7 stocks that have had particularly strong market performance, largely in the tech space. They would fall in the growth category. What this chart is showing is historically, those high dividend payers trade at about a 12-13% discount to that. That discount today is actually double. So those the price earnings ratio of high dividend stocks versus the S&P 500 are trading at a significant discount and are arguably very cheap today. So we talked about the 4-year presidential election cycle going back roughly 100 years. That navy blue, that dark blue line is historically the market movements over that 4-year presidential cycle. If you add that up over the last 2,800 years, 25 cycles. And the lighter blue line is what the market has done during Biden's presidency. So as you can see, if we follow the historic cycle, 2024 should be a reasonably strong year. The third year, as we noted in previous videos, is the third year is typically the strongest of the 4-year out of the cycle. This is a very interesting chart that I think is worthy to talk about. I follow an organization called the Visual Capitalist. They send out one email every day. It really is interesting. They have a wide variety of topics, but this one stood out to me given my profession and what I do for a living. What this chart shows you is the expected investment returns by investors versus financial professionals. The US stands out wholeheartedly as the largest. Investors in the US expected in 2023 to earn an average of 15–16%, where investment professionals view that a 7% is a reasonable rate of return. And so investors' expectations were 2.2 times greater than financial professionals. In Canada, it's similar, not near as bad. If you move halfway down the list, you'll see that kind of 6.5% is what investor professionals in this community and this country feel is a reasonable rate of return more often than not. But the average retail investor thinks 10 to 11% is more reasonable. So that's a 1.6 times what investment professionals think. So there really is a distortion about what is a reasonable investment return. I found that chart to be very interesting. So that's it for our fourth quarter year-end update. We'll be back to you in a quarter to give you an update for the first quarter of 2024. We'd love to hear your feedback. Please reach out, share with us what you'd like to hear, and all the best in 2024. I hope it's a great year for you. I hope this trip around the sun is the best yet for you. Thank you and take care.